Hi, everyone. As you guys are filtering in, I'll go ahead and do some quick introductions. We'll go over some housekeeping items, and then we will go ahead and get started. So my name is Ellie. Thank you for coming. Thank you for joining us. We appreciate that you join us for these webinars and participate. It means a lot to us, and we really appreciate it. So let's do some housekeeping items very quickly here. First and foremost, if you are here for CPE credit, we do need you to do a few things in order to receive that CPE credit. We do need you to fill out our poll questions as they pop up on your screen. If you have any issues with that, please just send me a message. I'm more than happy to help you get that sorted out. We do have to have a response for those poll questions in order to award you CPE credit. We also need you to fill out the survey at the end of this webinar. It will pop up for you automatically as you are exiting. It will also be emailed to you in 24 hours. So couple things you definitely have to do there. Another quick piece of housekeeping items here. If you have questions as we are going along, please reach out and ask those questions. You can use the Q&A button in the middle of your screen to ask those questions. We're going to do our best to answer them at the end of this webinar or following up with you via email. We also will be sending today's slides and handouts in the chat box once we get started. They also are uploaded to Zoom and will be emailed to you in 24 hours. So there are a few ways you can get your hands on those slides and handouts. And one more thing here. If you love our webinars, if you love the live version, if you're looking for a pre-recorded version, we do offer that in our Salt Vault. We also offer it individually as well. So please reach out if you have any questions or visit that web address listed. And a quick introduction for Sales Tax and More here. Sales Tax and More is a full service consulting and solutions firm. We have a great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, audit defense, and like our name states, more. So if you have questions about our services, please reach out and ask. We'd love to work from you and we'd love to hear from you. And a quick introduction for our founder and today's speaker, Michael Fleming. Mike's state tax knowledge is very well-rounded, and he has helped thousands of companies of all sizes and in all industries, and is especially well known for his work in the e-commerce industry. Mike, if you want to take it from here, let's go ahead and get started.
All right, Ellie, thank you for that wonderful introduction. And the big question for today is, does a physical presence for sales tax even matter anymore? I mean, everyone's talking about economic nexus. So by the end of today, we will have an answer for this. And I hope that you will all see that perhaps it's, yes, it does matter, and it matters more than ever. So we're going to cover very quickly, we're going to do a nexus definition. We're going to talk about some court cases. We're going to talk about economic nexus, and just to compare and contrast a little bit here. Then we're going to roll into the physical nexus. And when we talk about physical nexus, there are obvious nexus creating activities, and then less obvious nexus creating activities, and then common and uncommon. So we're going to talk about all of that. We're going to debunk some myths. We're going to talk about some case studies. We're going to talk about how states find you, what to do if you do have nexus, and then why physical presence nexus matters more than ever. We're going to touch on. So as always, the worst time to find out that you have problems or that your clients have problems is when you're being contacted by a state, when you're getting audited, or when you get a nexus questionnaire in the mail, or so state picks up the phone and telephone calls you. And the reason why that's the worst time is that most states have programs where you can limit some of the past liabilities, or actually eliminate some of the past liabilities. But once the state contacts you, a lot of those programs are off the table. So it pays to be proactive. If you're reacting, never a good thing, not enough time to fix things, and you can't take advantage of any of these programs. So, Ellie, with that, why don't we go to our first poll question?
Absolutely, and that should be up on everyone's screen right now. The poll question is, how would you rate your Nexus knowledge? And Mike, right away, it looks like our answers are all over the map here. And your video is lagging a little bit, so I don't know if you want to shut it off for the remainder of the webinar going forward, but looks like really a full spread across here. We have some experts, we have some absolute beginners, and many people who fall right in the middle. So I'm going to close this out and we can move forward.
All right, and I did turn my video off there. Sorry about the lag. Um, let's uh, let's get started with a quick definition of nexus, and it's just a fancy word that means link or connection. And when we're talking about taxes, it's the link or connection that must be present with a state before that state can require you to do anything like collect its taxes, like a sales tax or a use tax. Use tax being a vendor's use tax, retailer's use tax, or pay its taxes, like an income tax or franchise tax or a consumer use tax. And that's why we say it all starts with nexus, because if you don't have this link or connection with the state, then the state can't require you to do anything. So no nexus equals no problems and no responsibility. Now, the problem is many companies and sometimes their advisors don't know where they have nexus. And sometimes they know, but for whatever reason, they decide not to take any action. So this is why I think we need to be proactive. This is why you're here today, to learn about these things so that if you do have nexus in the state, that we can you can take advantage of that knowledge and rectify whatever needs to be changed. All right, so let's touch on some court cases. National Geographic versus Board of Equalization. This is becoming more important nowadays. The takeaway in this case, by the way, these are all U.S. Supreme Court cases. The takeaway in this case is that taxable activity does not have to relate to the nexus creating activity. So in other words, once a company has nexus, it has nexus for all its business channels. You can't pick and choose and say, well, uh, this is my retail business and that's my wholesale business. The one can create nexus for the other. And that's why this is a big issue. A lot of companies during the pandemic saw how well people who were selling online direct to the consumer did. So they started selling online. You know, many companies were distributors and selling to other businesses. Many were wholesale only. Some manufacturers was selling to distributors, and now they've decided that they're going to sell directly to the consumer. And they're thinking, you know, in a state like Texas, well, I don't have to worry until I get to $500,000 to worry about collecting tax. That's the economic nexus in the state of Texas. And unfortunately, they may have had, you know, nexus for their wholesale operations for the last 10, 15 years. And it didn't really matter because they didn't have to collect any tax. Um, so in that instance, the wholesale operations are the nexus creating activity, and the retail direct to the consumer would be the taxable activity. So these companies should be collecting tax from dollar number one rather than waiting till they get to that $500,000 threshold. And we're seeing this become a bigger issue with more and more companies. Second case I want to talk about very briefly is Complete Auto Transit versus Brady. And, you know, a lot of times, especially when we're dealing with online sellers, they say, well, you know, the states don't have the right to tax us. Only Congress can regulate interstate commerce. And that was true. I mean, even the states believed that back in the 1930s when the first, you know, uh, the modern sales taxes came into being, the 1930s. The states didn't even believe you could tax interstate commerce directly. But that started to change in the 1950s. And by 1977, there were a number of different cases out there. And in this case, the U.S. Supreme Court, they didn't decide anything new. They just cobbled all these other cases together and they came up with a four-pronged test. And they said if um, a tax passes the four-pronged test, then yes, a state can tax interstate commerce. And it's a pretty easy test to meet. So since 1977, we have this ruling from the state from the Supreme Court that states can tax interstate commerce directly. When we're talking about physical presence nexus, I think these two cases are perhaps the most important. The first one's 1960 case, Scripto v. Carson. And Scripto was a pen company. They were located in Georgia. They had 10 independent sales reps in Florida. And Florida said, we think that's enough of a significant presence that you should be collecting and paying our sales taxes. And Scripto said, you're out of your mind. These are true independent contractors. We don't control them. How in the world can they create nexus for us? And unfortunately, when this went to the U.S. Supreme Court, the Supreme Court sided with the state of Florida. And they said the difference between an employee and an independent contractor is without constitutional significance. We see this revisited 27 years later in Tyler Pipe. It was a Texas company, and the Washington Department of Revenue said, hey, according to Scripto, we think that you should be paying our business and occupation tax. And Tyler Pipe said, oh, no, this is not like that at all. This person, they don't represent us exclusively. They represent multiple parties and they're not very good at their job. It's like having a part-time person. They hardly send us any business at all. And unfortunately, again, the Supreme Court comes down on the side of the state. And this language is very, very important here. And what the Supreme Court said that if it doesn't matter what, I'm paraphrasing the first part here. Doesn't matter what you call them, doesn't matter how you pay them, doesn't matter if they represent you exclusively or whether they represent multiple parties, doesn't matter if they do it on a full-time or a part-time basis. Here's what matters. Are they helping you to establish or maintain a market? And if they're helping to establish or maintain a market, then that can be nexus creating. It's probably nexus creating. And the reason why that language is so important is because so many of the states took that language and incorporated it directly into their statutes, their rules, their regulations. They use it to provide guidance. The state courts use it as precedent. So very, very important. And in all my years of doing this, this is the one issue that trips up more companies than anything else. Because when we're thinking about the activities that we do that can create a link or connection with the state, we don't often think about our relationships with third parties. Sometimes this is referred to as attributional nexus or agency nexus. I try to keep it simple. I just call it third-party nexus. Third parties who establish or maintain a market for us can create nexus. This is very important. We're going to touch on this again a little bit later. Right now, I want to talk about South Dakota versus Wayfair. This is the case that overturned the requirement for physical presence. And, the Supreme Court, they didn't come out and said times have changed, so we have to change. What they came out, they said we made a mistake. We never should have introduced the concept of physical presence to begin with. So they overturned the Quill, which was 1992 case, and they overturned National Bellis Hess, which is a 1967 case. These are the two previous Supreme Court cases that had to do with a physical presence nexus. And what this allowed was the ushering in of economic nexus for sales tax. For income tax, Quill, believe it or not, ushered that in back in 1992. But for sales tax, this 2018 case ushered in economic nexus. And an economic nexus simply means that this link or connection that we talk about can be based on just on a sales figure or on a number of transactions in the state. South Dakota at the time thought that $100,000 or 200 transactions was a fair number. Now, the U.S. Supreme Court didn't actually agree to this. They sent it back to the lower court to get hashed out, and the case was settled prior to this getting hashed out. But a lot of states jumped on this bandwagon, even California. You know, when they first rolled out their economic nexus, it was $100,000 or 200 transactions. And we've seen a move away from those transactions. You know, California came out soon after this. And they said, you know what, that number may be fair for South Dakota, but for us, we're California. You know, we think $500,000 is a fair number for us, and we're going to do away with the transactions totally. And there's a current trend out there away from transactions. We're seeing more and more states move away from it. Now, it doesn't mean all states do. As soon as I say that, people start saying, well, I don't have to worry about transactions anymore. Maybe, you know, 2, 3, 4 years down the road, maybe that's true. But right now, there's about 40% of states that still have this 200 transactions. And some of the states are big, like in Illinois or New Jersey. So we still have to look at that in a number of states. All states that have a sales tax currently have some sort of threshold. Missouri was the last one that became effective in January of 2023. Even Alaska has a threshold now. They don't have a state level tax, but they do have local level taxes. And the Alaska Municipal League was formed, and they administer the taxes for the local jurisdictions in Alaska. And if you have $100,000 or 200 transactions in Alaska, you're supposed to be collecting and remitting tax in all of these local jurisdictions. Not all of them, but the bigger ones have opted in to this Alaskan Municipal League's tax administration. Couple of things I want to say about this. This is not an internet issue. A lot of people refer to this as the internet tax. Well, number one, tax and nexus are two entirely different concepts, but this is not limited to the internet. You don't even have to have a website to be impacted by economic nexus. This is a multi-state issue. You can sell entirely over the telephone. You can sell entirely by referrals. You can sell by catalog. You know, you can sell by smoke signals. You know, it doesn't matter how you're selling. What matters is, are you selling into multiple states? And if you're selling into multiple states, then you could be impacted by economic nexus. Now, another thing I'd like to say is this does not override any other type of nexus. You know, if anything, a physical presence is going to trump an economic nexus when it comes to sales tax. Not always so on other types of taxes, but when it comes to sales tax, almost universally, that physical presence is going to trump the economic nexus. And here we are, we're coming up on 6 years. You know, this June will be 6 years. So we still have people calling us and thinking that because they're below a threshold, they don't have to collect tax anymore and they want to deregister. So I'll get a call, you know, a couple times a month, and maybe from an existing client or a previous client, existing client, I'll know more about, and they'll say something along the lines of, "Hey, Mike, I want to deregister in California." And I'll say, "Okay, how come?" "Well, our sales are below $500,000. That's the threshold." And I'll agree with that. And, they don't have any transactions. So we're below those thresholds. And then I'll say something along the lines of, "Well, last time we talked, you had a independent contractor who was traveling into the state to make sales, or you have inventory at an Amazon warehouse." And they say, "Oh yeah, I still do, but I'm underneath the thresholds." And at that point, I have to let them know it just doesn't work that way. A physical presence is going to trump that economic nexus. This doesn't protect you at all. It's just one more way for the states to get you to do what they want you to do, which is collect and pay their taxes. So we have a chart out there. Ellie's going to hand this out. This gets updated quite frequently. I think the latest update might be as of January 1st this year. We're going to need to make a couple of new adjustments to it because there are a number of states that currently have legislation pending to get rid of that transactions. So whenever those change, we will go out there and change this. This is a great chart to have. A lot of software companies out there tell you, well, our software will tell you when you need to get registered, and our software is the be all end all. And unfortunately, I have not seen any software yet. It doesn't matter what company it is. It doesn't matter if it's a company using software in the background like Shopify. It doesn't matter if it's Avalara or whoever else. They just don't get granular enough to give you accurate recommendations. For example, if it's Shopify, maybe you're only running your retail sales through that, and you're not running your wholesale sales through it or your marketplace sales through it. And a lot of these thresholds, if you look in the middle of the page there, what states say to include or exclude from the remote seller's threshold calculations. So some states say gross sales. You got to include it all. And that's usually what these software is telling you. But some states say sales through a marketplace exclude, sales for resale exclude, exempt sales exclude. Some states say you need to exclude sales for resale, but all other types of exempt sales you have to include. So what happens is if you're just looking at software, what the software is telling you, we've seen clients end up getting registered in way too many states because that's usually based on the gross sales. They're not looking at the exact fact pattern of the company. So the software is a great red flag. It's a great tool that acts as a red flag. It alerts you to an issue. And then you need to pull out a chart like this and say, okay, based upon my breakdown of sales, do I actually need to get registered? And if you do, then great. If you don't, then you look either the following year, some of these every calendar year. So December, January is when you really want to be looking at this. Some say previous or current calendar year. So you'll have to check it if your sales are growing quickly throughout the year. But this chart, I think it's invaluable. The other thing you got to worry about is sometimes this software, you're not putting everything into the software, so it doesn't have all the information to give you an accurate recommendation. So again, keeping this chart handy can be invaluable, and it's always out on our website, on the free portion of our website. All right, so let's go to myth number one. I don't have to worry about sales tax nexus if I'm under the economic nexus thresholds. That's just not true. If you have a physical presence, which we're going to spend a bunch of time on today, you do have to worry about sales tax nexus. All right, so in the intro, we talked about physical presence having some of these activities are obvious, some are less obvious, some are common, which means that pretty much all of the states or the majority of the states, if not all of the states, consider them to be nexus creating. And then you have others which are state specific nexus creating activities. Very few of the states consider them to be nexus creating. All right. So real property, whether you own it, whether you rent it, whether it's an office, a warehouse, a factory, I think most of us will agree that this can create some sort of link or connection with a state. And it's very common. I don't know of a state that doesn't say either owning or renting real property is nexus creating. And virtual offices. This one, um, not so uh, I'm having a brain freeze here. I apologize for that. Um, this one is a little bit, people are taken a little bit by surprise from, because a lot of people say to me, well, Mike, you know, I don't have this link or connection that you're talking about. Everything's in the cloud nowadays. We have a virtual office. There is no real property. Well, unfortunately, the states don't look at it that way. You yourself are actually the link or connection. And where you live or operate your business from creates this link or connection. And this is a very common nexus creating activity. So, big issue. And as more and more people move to the cloud, we're seeing this become more common. Employees can create a link or connection with the state, even remote employees. Now, some states are going to look at what the remote employee does, but that's going to be the exception rather than the rule. Most states just say having an in-state employee's nexus creating. Now, this is a big problem because during the pandemic, when everyone was working from home, a lot of states put all of this on hold. But the pandemic is over, and all of these states have put these rules and regulations and statutes back in place. And remote employees do create nexus, and they're out there looking for these uh, types of companies that have these types of activities in their state. It's very, very common. So employees can create a link or connection. We mentioned this, independent sales reps, manufacturers reps, independent contractors, subcontractors, etc. Um, 2 U.S. Supreme Court cases. This has got to be one of the greatest areas of exposure. In all my years of doing this, I've seen this trip up companies greater than anything else. And it's very, very common. So it's not just related to sales, though, or independent contractors. Um, it can be subcontractors. It can be independent contractors. You don't even have to put a label on it. Any company that is performing services on your behalf could be creating this link or connection. It's very, very common. All states look at this as nexus creating. The Supreme Court has 2 cases about it. The states see that as a layup. So uh, again, we said we call this third-party nexus, and it doesn't make common sense. So that's why this is such a big issue. If we're thinking about the activities that we do that can create this link or connection, we often overlook the activities of third parties. Now, on the screen, you'll see a list of activities there. It's by not a total list, it's just some examples. These are the types of things that fall under that umbrella language of helping to establish or maintain a market. Now, what we tell our clients is that if you're sending someone into a state and they're working with your customers or they're working with the public, then that is generally going to be an activity that helps to establish or maintain a market. But not all third-party relationships do. For example, let's say that you have someone developing software and you're paying them on a 1099 basis. Well, they're not generally viewed as helping to establish or maintain a market, or you hire a bookkeeper on a 1099 basis. Again, not helping to establish or maintain a market. So it's not all third-party relationships, just those relationships that help to establish or maintain a market. And you've got some examples on the screen there. Let's go to our first case study. And this is an older case study. This is when Amazon had about 7, 8 warehouses or so. And we had a gentleman, he was an early adopter. He registered everywhere that Amazon had a warehouse. His home state of Missouri did not have a warehouse. And since most independent contractors are paid on a 1099 basis, a lot of states check with the IRS and see who has gotten a 1099. So he gets contacted by the state of Missouri, and they said, "Hey, we see that you got a 1099 from Amazon." And he said, "Oh, yeah." And he said, "Well, Missouri said, we think you should be collecting and paying our sales tax." He said, "Oh, no, I don't have any connection with the state here. I got a virtual office. Everything's done at the cloud. Everything's done at Amazon." And he contacted us at that point. He wanted us to make that argument on his behalf, which we did. We told him we didn't think it was going to work, and it didn't. So the state said, they sort of chuckled and said, "Yeah, that's not going to fly." He himself is the one creating this linker connection. So unfortunately, the state had him, dead to rights, and we helped him out. Not everything he sold was taxable, so we got the numbers down. But he had to pay some decent money. And here was a pretty smart guy. He was out ahead of the curve, but he just didn't think of his home state here. He thought that the virtual office being in the cloud was going to protect him. All right, so it's not just where your employees or contractors live, but anywhere they travel on your behalf. And this one's a little bit harder to track. Harder to track for the states. So it's not usually high on their radar if it's a sales employee, because it's not going to show up on an invoice. So some companies, don't even know where their salespeople are traveling. So salespeople low on the state's radar. What's higher up on the radar? Let's say you're doing installations or implementations, and you're charging for it. That is going to show up on an invoice. And if a state audits one of your customers and they see that, that's one of the ways, and we'll talk about it in a little bit here, one of the ways that states find you. So that's much higher up on the radar. So when we're talking about employees, traveling into a state on your behalf for just about any reason is going to be nexus creating. States like Michigan and Arizona say that if you're here greater than 48 hours cumulatively throughout the year, that's nexus creating. So those remote employees, they're not traveling, they live there, they're creating that linker connection. Independent contractors, subcontractors, they still have to be held to that higher standard. They still have to be helping you establish or maintain a market. All right, Ellie, why don't we go to the next poll question?
Absolutely. Question we have here is, what about sales tax nexus concerns you the most? Your choices are nothing, you have a down, economic nexus, third party, travel, and other. Quick reminder, you do have to answer these poll questions in order to receive CPE credit. Mike, we have a really good mix of answers here. Most people are answering third parties. If we want to just talk about this very briefly, I'll close it out and then we can move forward.
Yeah, third parties is a big one. Economic nexus, because it's relatively new and it's changing all of the time, but third parties, because it defies common sense. A lot of us just don't think about it. By the way, my brain unfroze, and the word I was looking for before was obvious, and less obvious. So when we're talking about a virtual office, that's less obvious. So not as apparent to common sense. Once I stopped thinking about it, I got the word. Um, let's go to another case study. And this is a specialized software company, and this case is probably 6, 7 years old now. So 37 years ago, the CPA was the fraternity brother of the owner of the company. And he said that, well, Nexus was created by traveling salespeople. So don't let your people travel and you should be okay. Well, for 25 years, there were no problems until they were contacted by the state of Washington, who said, "We believe you have Nexus here." And the company said, "Oh no, we don't have Nexus. None of our salespeople travel. They all make calls, sales over the telephone. They're all right here. They never leave." And the state said, "Well, we audited one of your customers and we have invoices showing reimbursements for travel. So somebody's obviously traveling, and you're billing for installations, and it's looks like software, and uh, all of that's going to be taxable." So the state wanted and got 7 years of back tax plus penalty and interest. And we get a call. Uh, the president of the company gave me a call, and he said he was in tears almost. And he told me about Washington finding him, and Washington saying, you probably got issues all over the country if you have this. Um, Washington was nice enough to point that out. So he's thinking he's going to jail. That's why he's almost in tears. And I have to talk him down off the ledge and convince him he's not going to jail. People do go to jail for not paying sales tax, but generally, um, they're they're people who are uh, hiding their sales. There has to be an intent there to rise to the level of going to jail. But if you do it by mistake, there could be what they call criminal penalties, and that could be 50% penalty or so. So even if you're not going to jail, it could cost you a heck of a lot of money, because those are on top of the other penalties and interest. And if you got to pay 7 years of back tax, that can be a lot of money in and of itself. So um, after I convinced him he's not going to jail, he said maybe he should be going to jail. Maybe that's a better solution, because at least he'll have a roof over his head and food on the table. Because once his bank finds out about this huge issue here, and he's projecting it's going to be somewhere between 15 and $20 million, they're going to pull all of his credit lines and they're going to go bankrupt. And let him know that there are ways out of this. And he asked me if I would talk to the bank, and we ended up talking to the bank. And the bank said, "Okay, is there a way out of this?" We told them, yeah. We outlined the program, and the bank said, "Okay, we're going to loan you the money to get yourself out of this mess. We're in so deep that we can't let you fail," which was a pretty good thing, because they had to do over 40 VDAs. And a lot of companies, when they have this much past exposure, they have to tackle it, 5 states at a time, 10 states at a time, because it's a lot of money to come out of pocket. So anyway, when all was said and done, we, did a couple of amnesties, we done a bunch of VDAs, we restructured a number of invoices, and they paid just over $1 million beside our fees. And I've never seen anyone so happy to pay $1 million in my life. But you got to remember where they came from. They thought they were going to jail, then they thought they were going bankrupt. And the bank worked with them. So $1 million, no one wants to pay that, but it was so much better than the alternatives. So, um, happy ending there. But here, for any of the CPAs on the line here, most CPAs are smart enough, and if they're not sure of the topic, they don't make recommendations. But we see plenty of people getting advice from CPAs that no one's ever come to us with when they have a big problem, and without saying, my CPA told me. And you never want to be in that position. You never want to be the one who gave the bad advice. So that's why you're here today. You're gaining information, and there are a lot of great CPAs out there who know when to say, "Hey, let's bring in a subject matter expert. This is not our area of expertise," or they do have a great state and local tax practice, and they've been doing it for years. So. Um, you just have to know who you're working with, and you have to know your limitations if you're on the CPA side. Let's go to myth number 2. It's never been a problem before, and we've been doing this for a blank number of years. It's not going to be a problem now. Those are famous last words. You don't know how many times I've heard these only to get a call 6 months, a year, 2 years down the road, because states aren't stupid. They're just a little bit slow to react sometimes, and they're out there actively looking for you if you're not compliant. So I can give you story after story. 30 years in business doing it one way, and it's never been a problem until it is. 15 years, 20 years. I mean, it's never a problem before it is. All right, so this is a big one. Ownership or rental of tangible personal property. If you're leasing or renting to others, you still own that property. And if you're leasing across state lines, well, you now own property in another state. That's creating the linker connection. And it's very common. I don't know of a state out there, with the exception of Illinois and Maine, that don't consider this to be an issue or a potential issue. They don't tax leases or tax rentals. Most states look at it the same as a sale of tangible personal property, or a type of sale of tangible personal property. City of Chicago does, so you got to be careful up in Illinois. But this is a very common nexus creating activity, and you got to look out. People say that Delaware is a state that doesn't have any sales or use taxes, and unfortunately, that's not true. They have one, use tax for rental or lease of tangible personal property. So if you are the lessor, you are required to collect it from the lessee. So that's something that a lot of people just don't understand. A lot of smart people just don't understand that Delaware does have some taxes, and most of the states that say they don't have a sales tax have some sort of tax very similar to a sales or use tax. It's just not a general tax, but they do tax certain items out there, even if they don't call it a sales tax. All right, so here's a case study having to do with a camera leasing company, and they were leasing high-grade camera equipment all over the country. The state of Massachusetts found them, said they had nexus due to owning TPP in the state, and this company said, we can't be doing it wrong. Everybody in our industry does it this way. Well, Massachusetts' response was, get us a list of everybody in the industry and we'll go after them also. So we got contacted from one of their competitors, and they said, "Hey, can you believe one of our competitors turned us in?" And yeah, that happens. So they asked if it was true, and yeah, they had problems in Massachusetts, but they also had problems all across the country. So we worked with them and we got them compliant everywhere in Massachusetts. Not everything they were doing was taxable, so we helped get the assessment number in Massachusetts down. But they unfortunately had interest. We got the penalty waived also, um, and it was quite a number. When states find you and you've not been collecting tax or not been registered, they generally go back either 7, 8, or 10 years. So 8 years of tax is a lot of tax. So that's why it pays to be proactive. Do something before the state actually comes looking for you. All right, trade show attendance. This differs greatly by state. So up until this point, all of the activities we talked about were common. In other words, most states, if not all states, were going to look at those as nexus creating. Well, trade show attendance is going to be different in every state. There are a couple of states out there that say, hey, if you attend as a consumer, then that is going to be nexus creating. Now, I have never heard of a state pressing that. I think that, if it went to court, they'd have a hard time, uh, making that stand. But participating as an exhibitor, uh, that's a whole nother level here. And that's what the majority of the states say. Some states say, okay, you can participate as an exhibitor, but if you have active solicitation, then that is going to be nexus creating. Some states say that you can actively solicit, but you can't take orders. If you start taking orders, that's going to be nexus creating. And then you have Nevada, who says you can sell, you can take the orders, you can even collect the money, you can even deliver the product while you're here. And so long as you don't do that more than once a year, it's not nexus creating. Now, you got to collect the tax while you're there, but when you're leaving, you give it to the promoter of the show, and they can either turn it in for you, or if they don't do it, then when you get back, you just mail it into Nevada. You do that twice a year, then that is going to be nexus creating. And by the way, people talk about de minimis activities when it comes to sales tax all the time. And states aren't very good about outlining what de minimis activities are, except when it comes to trade shows. And there are a number of states who say if you're here for less than a week, or if you're here for less than 2 weeks, or if you're here less than 2 weeks and less than $100,000 of sales take place, then it's not nexus creating. So that's where this differs greatly by state. Some states say, hey, if you're here, we consider this to be active solicitation, so therefore it's going to be nexus creating. Delivering your own trucks. And this is if you own the truck, whether you're leasing the truck, whether you have a captive company. Maybe you set up a company and it's a separate company, but all they do is work for you. This is generally going to be nexus creating. So anyone who does not hold themselves out to the general public as a trucking company, this is generally going to be the definition of a common carrier. So common carriers hold themselves out to the public as a company, and if they're not, that can be creating nexus. Very common nexus creating activity. All right, so inventory creates physical presence nexus in most states, whether consigned, stored, or carried by sales representatives. Since Amazon started collecting the sales tax, a number of states have changed their position about inventory in Amazon warehouses. The state of Texas says if that inventory is only going to be used to fulfill Amazon sales, then it no longer creates Nexus. However, if you're using it to fulfill your Shopify sales, then that is Nexus creating. State of Arizona says if you're shipping it directly to Amazon in Arizona, that is going to be Nexus creating. But if Amazon moves it to Arizona, that is no longer Nexus creating. But still a big issue. Most states out there, even though Amazon's collecting the tax, they believe that the inventory in the Amazon warehouses still creates Nexus. And if not, Pennsylvania, they got their hands slapped when they were saying that it was enough for sales tax, but for income tax purposes, they're still saying that. So inventory in a warehouse, even an Amazon warehouse, can create Nexus. And if third parties can create Nexus, how much easier is it for related entities to create Nexus, especially if they are performing services for each other? Some states even say common ownership with similar names and products is enough to create Nexus. Now, to keep this, you got to operate the two businesses as totally arm's length. Some people say, oh, yeah, we operate these as arm's length, and then they're sharing inventory or sharing bank accounts or making journal entries back and forth between the two companies rather than actually selling them the inventory. So there are ways around it, but a lot of companies get themselves in trouble when they have a sister company and they're not keeping it at an arm's length. All right, next polling question, Ellie.
That question should be up on everyone's screen right now. We have a little bit of a quiz, true or false question. True or false, activities of third parties create nexus if they're helping to establish or maintain a marketplace. Let's see. And Mike, most people are saying true right away. Quick reminder, you do have to answer these poll questions in order to receive CPE credit. So Mike, if you want to just review this one very briefly, and then we can move forward.
We've got a smart group here today. Maybe they should actually be giving the presentation. No one got this question wrong. Everyone is saying true, and true is the correct answer. All right, so not everything is relatively apparent that it's a type of physical nexus. For example, click-through nexus or affiliate nexus. This is where someone clicks on a link, they're taken to a third-party website, and if they purchase something on that website within a certain period of time, a referral is made. So it's called click-through nexus because of that link, but it's really if you're paying anybody anything for sending your business, it could fall underneath these definitions. At the height, there were 21 states that had click-through nexus or affiliate nexus. This came about, the state of New York went after Amazon and Wayfair, and they said, you know what? Based on Tyler Pipe, one independent contractor sending business created a nexus. Well, how about a whole state full of people that are sending you business and you're paying them some sort of referral fee? Is that not, a heck of a lot worse? And the highest court in the state of New York said, yeah, Supreme Court didn't hear this one. So right after that, we saw a lot of companies jump on the bandwagon. And even though there are thresholds, the thresholds are somewhere between 5,000 and 500,000. This is a type of physical presence, just like in Tyler Pipe. So a lot of states, since we have economic nexus, have sunset their laws. But if you're out there trying to figure out when someone actually, their nexus began, and you're just looking at their economic nexus, well, if they have a program like this, and most people who have programs like this advertise it on the website, it's real easy for a state to find, could become a major issue. You're thinking you've got 2 years worth of exposure, and you really have 12 years worth of exposure. All right, use tax notice and reporting requirements. This is perhaps the most heinous thing that I've ever seen a state try to do, and the Supreme Court let them get away with it. Uh, the- Basically, this started with Colorado. Colorado wanted some of the online revenue. And back in 2010, they did not have any Amazon warehouses in the state. So they said, we can't make you get registered here because you don't have the inventory here. So we're going to make your life so miserable that you're going to throw your hands up and say, I give up. I'm just going to register voluntarily so I don't have to deal with this anymore. And, it's a series of 3 to 4 notices depending on the state. And the notices basically say, I, the seller, am not collecting sales tax. So you, the purchaser, must pay the tax directly to the state. And oh, by the way, at the end of the year, I'm going to turn a list of all my clients and all the purchases over to the state, or the amounts of their purchases over to the state. At best, that's a horrible marketing message. I mean, the customers would say, you're not doing your job and you're making me do extra work because you're not doing your job. So that was the best. If you were non-compliant, the penalties were draconian in a number of these states. Oklahoma is the worst. Oklahoma, you have to do 3 things. They have a $10,000 threshold, and um, how many sales do you have to make to get to $10,000? Say it's 200. Well, 200 times 3 things you have to do per transaction. All of a sudden, we're looking at 600, and the penalty is based upon $20,000 for each transaction, or 20% of the previous year's revenue into Oklahoma. Well, 20% of $10,000 is $2,000. Well, if you've got to look at 600 times 2,000, what's that? It's 1.2 million. You're in 7 figures pretty darn quickly. So it's unbelievable. So, and that is still in effect as of right now. Most of these use tax notice and reporting requirements were sunset with economic nexus. We still have to worry about Louisiana, Vermont. The penalties are very, very small. We don't worry about that too much. Puerto Rico, I tell a lot of clients, it's not worth selling into Puerto Rico. I mean, you're making 4 or 5 sales a year. Based on these 4 or 5 sales, you could have penalties of $25,000. It doesn't even justify registering for sales tax. Your sales are too small. But if you have substantial sales, then you'll want to get registered. By the way, on this notice and reporting, the states wanted you to register voluntarily. So once you register voluntarily, you don't have to jump through these notice and reporting hoops anymore. So um, Oklahoma, I definitely would pay attention to. Puerto Rico, I would definitely pay attention to. Vermont, Louisiana, not as much. All right, so this just gives you an idea of how crazy the states can get. And this was before economic nexus. Some states consider software to be tangible personal property, even when downloaded. And when you're selling software, a lot of times you're just licensing that software. If you're licensing the software, then you keep an ownership interest in it. Customer downloads the TPP, the tangible personal property that you have ownership of. You now have a physical presence in the state. That's what Texas said. This is Texas specific, and it went to a hearing, and the ALJ said they upheld it. They agreed with the state of Texas. So this went to the court system, and this was an end run. How can this be physical presence? Someone downloads something. How is that a physical presence? Well, went to the court system, and before they had a decision on it, they settled it in a closed settlement. So Texas knew they were wrong, but they kept doing it. And every time someone took them to court, they settled it. So these companies were paying money for these settlements and their court fees and everything else when Texas absolutely knew they shouldn't be doing this. So just gives you a little bit of some insight into the mindset of these states. Sometimes everyone says, oh, well, the state will help me out. They'll deal with me when they find me. Not so much. All right, so here are 10 common nexus creating activities for sales and use tax. And as we said earlier, common means the majority of these states treat it as nexus creating, or in some instances, all of the states treat it as nexus creating. And that's in direct contrast to the 12 state specific nexus creating activities, where maybe just one or two states or maybe 10 states, but definitely not the majority of states or all states. Ellie's going to hand out both of these sheets here, and they're also up on the free portion of our website. So how do states find you? Well, biggest way that states find companies that are selling to other businesses is auditing your customers. And we had a case study, the specialized software company, where that was how the company was found. We had the Massachusetts case where a customer was audited, and that's how the Cameron Leasing Company was found. Information sharing with other states or with the IRS. That's how Missouri found the Amazon seller. You've got Amazon telling people where they have inventory. So that's less of an issue now that Amazon is collecting tax. But it's still an issue if you're selling on other platforms like Shopify. Then you have web surfing. Washington, the state of Washington, real big. State of California was real big. Some of them, the auditors do it manually, and others, they have specialized software called web crawlers that look for certain terms. Leads. Every state has a discovery unit whose primary focus is to follow up on leads and find companies that they think should be paying their taxes that aren't currently paying their taxes. So leads can come from former employees. I mean, there are states like Florida that, pay bounties. You get a percentage of the money that's found. States like New York. So you could have a disgruntled employee. Not only can they get their pound of flesh by turning you in, but they could get paid for doing it. Competitors. We saw in Massachusetts, the competitor turned in the companies. By the way, this is a bigger issue. A lot of people who are not compliant for economic nexus say that they would become compliant if their competitors were compliant. So we get asked questions all the time. Is there a way to turn in my competition? And unfortunately, in every state, that pretty much is. Customers, usually this is pretty innocent. You don't charge a customer tax, and they call the state and say, hey, am I supposed to self-assess use tax on this? And the state says, well, who's your vendor? Next thing you know, you're on a list. And being on a list by itself is not a problem, but it could be a problem because the state will eventually get around to you. And if you have a responsibility to collect the tax, then, you know, it's too late. The state's already contacted you. So you're going to pay the higher taxes, the higher penalties, and the higher interest. And then some states out there, like the state of Utah, are actually purchasing lead lists, people they think who are over the thresholds or who have nexus in the state. So if a state finds you, in theory, they can go back to the date you first started doing business in the state. It could be 20 years ago. In practice, they routinely go back 7 to 10 years, depending on the state. They go back 7 years, 8 years, or 10 years. I don't know of any states that go back 9 years. But they're not limited to that. I had a case where the state of Texas was going after a pool cleaning guy, never did more than $75,000 a year, kept all of his receipts and shoe boxes, and they wanted the last 12 years worth of records from him. That's when he got us involved, and we beat him back to 7 years. But 7 years, that's still a long time, especially for a guy with his receipts and shoe boxes. And he was getting ready to retire. He couldn't retire because he had to pay the state back. So he needed to stay in business. So A state's going to want back taxes, penalty, and interest for the entire period in question. Penalty and interest can quickly exceed 50% of the tax owed. Mitigation options are limited or disallowed if the state finds you first. All right, Ellie, you want to go to the next poll question?
Absolutely. That should be up on everyone's screen right now. The question we have is, how does the state find you? Your options are auditing your customers, information sharing with states or the IRS, Amazon tells them, web surfing or web crawlers, or all of the above. And quick reminder for everyone, you do have to answer these poll questions in order to receive the CPE credit. Mike, answers are still rolling in pretty quick here. Most people are answering, or everyone really is answering. Most going back and forth here as answers are rolling in. Most everyone is answering all of the above. Mike, if you want to review
Yeah,
this one quick, we can move on.
and that is the correct answer. I mean, those aren't the only ways that states find you, but those are some of the more common ways that states do find you. All right. I've even had situations where, there were spouses and they were going through a bitter divorce, and the one spouse would throw the other spouse underneath the bus. Partnerships breaking up, one of the partners thinks that they got the short end of the deal, and next thing you know, they're turning you into the states. So it can get real ugly out there. Lots of ways for states to find you. All right. So the moral of the story is be kind to your spouse, be kind to your partners, be kind to your employees. If you're not squeaky clean when it comes to compliance. All right, so what should sellers do? Well, sellers should register wherever there is nexus. The potential exposure is material, and what they sell is taxable, and the marketplace is not responsible for collecting. Well, materiality is my comment, not the state's. I think we need to use common sense. Most states believe you should register from dollar number one. Now, if the cost of compliance exceeds the back tax plus penalty and interest, does it make sense to file? My answer is no. For example, let's say, it's a state with a 200 transaction and you're selling something for $5. That's $1,000 in tax, excuse me, $1,000 in sales. At an 8% tax rate, you're looking at, $80 worth of tax, penalty and interest, even if you doubled that instead of, 50%, now you're looking at $160 worth of tax, penalty, and interest. Some states make you file, once you get registered, file a return every month. I don't know how, even if you're doing everything yourself, there's opportunity cost. How do you get registered and how do you file a return every month for less than $160 a year? So even though the state says that you should be registered, you should be filing. I say that if it's not material, if the cost of compliance is going to be greater, then, sometimes it makes more sense not to do what the state tells you to do. It doesn't make good business sense. Now, people always say, well, Mike, what's material? And I can't tell you what's material. Look at Coca-Cola. To them, $100,000 is a rounding error. To me, $100,000 is a lot of money. And for you and for your clients, it's going to be the same thing. Each of us needs to determine what's material to us. And the three things that people, when they're trying to figure out if something is material or not, is risk tolerance. Am I losing sleep at this night? And we have some people calling us who can't sleep. They hear footsteps. They think the state's going to find you. Well, go ahead, go out and get registered. Have that low personal threshold. Other clients say, Mike, I go to Vegas every week. I never lose. Nothing bad has ever happened to me in my life. And I don't think the state's going to find me. Well, they can afford to have a higher risk tolerance there. They can have a higher personal threshold. Profit margins. And this is counterintuitive. Some companies say, well, Mike, I can't afford to be compliant. I don't have enough money to pay for the cost of compliance. And yes, there are costs of compliance. However, it's these smaller companies that have the greatest risk. If you're a bigger company, if you have 30, 40, 50% profit margins, there's a little bit more room to move there. But if you have a 2% profit margin because you're trying to build market share, the average sales tax rate is 8%, penalty and interest, 50% of that. You're looking at 12% just for this one state for every year that you're doing business. So state finds you 4, 5, 6, 7 years down the road. Not only have you wiped out the profits from that one state, you may have put yourself out of business, especially when you realize states talk to each other. Not all states, but there are groups of states that talk to each other. And sometimes after one state finds you, 6 months down the road, you'll start getting calls from 2 or 3 other states. So profit margins, big there. And then capital reserves. You got a lot of money in the bank. You put money aside for a rainy day. And this used to be a lot bigger issue before economic nexus. People were playing the odds. Nowadays, not as much. But again, if you don't have the money set aside and a state does find you and demand all this money, it could put you out of business. So um, that's why this is counterintuitive. It's the smaller companies, the companies that could be really hurt that need this the most. I look at this as like insurance. Insurance is always expensive and it doesn't add a whole lot of value to properties. I've got a few properties that are free and clear. I don't need the insurance on it, but what happens if and I don't think my property is going to burn down, but what happens if I'm wrong? What happens if that property does burn down? I'll be kicking myself because at that point, the insurance premiums are going to look like pennies compared to what it's going to cost to fix the house. And it's the same thing here. The cost of compliance, if you're doing the compliance correctly, then any audit assessment you have should be minimal. And that compliance, the money you spent on the compliance is going to look like pennies compared to what the problems could be. Now, there are different ways to register. You can register just going forward, and sometimes that's what you need to do. You may have just crossed a threshold. However, there are some companies that say, I didn't understand what was going on. I didn't realize I had Nexus, and I'm going to register prospectively anyway, even though the state doesn't want me to do that. There are some states where people get away with this all the time. There are certain states you cannot do this in. The state of Illinois, the state of Wisconsin, they will audit you for your start date. Not right away. They'll usually give you 2 or 3 years, but they'll get around to you. And the state of Arizona just started doing the same thing. What the states want you to do is register historically. In other words, tell them when your date of nexus began, and they want the back returns and plus penalty and interest since that date. Now, sometimes you can ask for them to waive the penalty, and they will, or you can register through a voluntary disclosure agreement. And voluntary disclosure agreement can be a great tool. Unfortunately, just like any other tool, it's not a one-size-fits-all tool. You got to see if it makes sense for you. What a voluntary disclosure agreement is, as a reward for stepping forward voluntarily, states are going to limit the look-back period to either 3 years or 4 years. Those are the most common dates. They're going to waive the penalty, and in a handful of states, waive or reduce the interest. So the state of California will go back 8 years if they find you. If you go to them first and do this voluntary disclosure agreement, they only want 36 months. So right away, you're saving 5 years worth of back tax plus penalty plus interest. And then in the 36 months that they do want the taxes for, they're going to waive their 10% penalty. So that's a pretty good deal. If you have the ability to pay that. And by the way, most states will set you up on a payment plan. So California is a very aggressive state, so a lot of people decide to do VDAs in the state. Now, let's say you only owe a state $500, and this kills me. There's a Avalara. I'll toss their name out there. We get a lot of companies that come to us and say, well, Avalara told me that if I owe more than $500, then I need to do a VDA. And by the way, their VDAs are $3,500. And I needed 40 VDAs. I had 120 some odd $1,000 invoice before I paid $1 worth of back tax, penalty, or interest. And I said, that's absolutely ludicrous. Why would you pay anybody $3,500 to remit $500 in back tax for you? I mean, do the historical registration, ask for a penalty waiver. I mean, it's just ludicrous. I don't know how these salespeople get up in the morning, look themselves in the mirror, but this is routine. It's not an isolated event. As a general rule of thumb, no matter who you're going with to do the VDA, even ourselves, we're cheaper than $3,500. Some of ours are as low as $2,100, depending on how many you're doing. But even with us, if you're not saving at least what the VDA is going to cost you, what the fees for the VDA are, if you're not saving at least that much money, in general, you don't want to do the VDA. You choose another option. There's exceptions to every rule. If you've got tax collected, not remitted, that could be a reason to do this, because the VDAs will not only waive any civil penalty, but they often will waive criminal penalty also. So there could be a reason to do the VDA, even if you have an amount less than the amount of the fees. VDA generally not available if the state has previously contacted you. As we said, VDA is a great tool, but like all tools, it's not for all scenarios. And by the way, be prepared for income tax also, because states are generally going to try to include income tax in a sales tax VDA unless prohibited by Public Law 86272. In California, they've got a great program. It's a managed audit. They're not the only state with a managed audit. But if the state has already contacted you, the VDA is off the table. So you might want to consider a managed audit. And a managed audit is performed by a third party like us under the supervision of the state. And the reason you'd want to do this, even though there's no limitation on the look back period, penalty can be waived and 50% of the interest can be waived. So you could, especially if you're talking about large dollar amounts going back, 8 years, you can save a lot of money by doing California managed audit. Well, a lot of people think, well, Mike, you're doing the audit for us. Can't you just let us slide on all this stuff? Well, unfortunately, we're doing it under the supervision of the state. So can't let you slide. Now, we can definitely work to represent your interest, and we can get things legally where we can get the amounts reduced. We can work to help you get past missing or incomplete resale certificates and things like that, but it's all got to be above board. All right, so common registration mistakes. Registering for sales tax rather than a seller's use tax or vice versa. So the wrong type of tax we see people getting registered for all of the time, especially since the Wayfair case. Registering with the secretaries of state. Most of the different online registration forms out there, they make it look like you got to register with the Secretary of State. But in just about every state, there's a workaround. Sometimes you do have to get registered with the Secretary of State, depending on what your activity is. But especially if you're just have an economic nexus, there's no need to get registered with the Secretary of State. Entering the wrong start date. This is a trick question. The state's going to say, when did you start doing business in our state? Some people say, well, I started selling there, 5-10 years ago. It's not when you started doing business in the state that they're looking for. It's poorly worded on purpose. They're looking for the date that your nexus began. So make sure that you're giving them the right information. And then registering through the streamlined sales tax program, free always sounds good until you get to the details. Number one, only a few companies can actually file the returns when you get registered through the streamlined sales tax. The visibility into the online accounts is absolutely horrendous. All sorts of problems with that. So Avalara is going to push this. I I can tell you horror story after horror story after horror story. We run from the streamlined sales tax program. All right, myth number 3, registering for sales tax creates income tax nexus. A lot of people tell us, well, we're not getting registered because we don't want to have to worry about the income tax. Well, sometimes the same activities that create nexus for sales tax create nexus for income tax. But registering for sales tax, I don't know of in any state where that creates income tax nexus. Now, sometimes you'll automatically be registered for the income tax, but if you don't have nexus, you can go back and argue the point. But registering for sales tax does not create an income tax nexus. Myth number 4, and we touched on this already, you have to register with the Secretary of State when registering for sales tax. And unfortunately, that's just not true. And this, in some states like Florida, when you register with the Secretary of State, it automatically gives you nexus for sales tax, or in a number of states, it automatically gives you nexus for income tax. So you don't have to register with the Secretary of State in all situations. And Ellie, let's go to the final poll question here.
That question should be up for everyone here. The poll question, hopefully, is a super easy one. Will you be joining us for a future webinar? Your choices are yes, absolutely, and maybe. Mike, and it looks like most people will be joining us for a future webinar here. We'll give everyone a few more seconds. You do have to answer these polls again to receive CPE credit. And we'll close this out in a second here and move forward.
All right, always glad to hear that people will be joining us again. All right, so we said that we were going to get to this. The big question, does a physical presence for sales tax even matter anymore? And my answer on this, my take is absolutely. And I think it matters more than ever. And the reason why is because of economic nexus. I mean, the states know that 50 to 60% of sellers are not compliant, depending at which survey you're looking at. They started gearing up before the pandemic to come after companies that were not compliant. They paused, but they've been, ramping that back up. And historically, when we have some sort of recession or some sort of downturn and states are starting to see their tax revenues drop, they ramp up their discovery efforts, they ramp up their compliance efforts, which means they're looking for more companies and they are auditing their existing companies. So I think that things are going to start to get ugly here. And while the states are primarily looking for this economic nexus, they're going to stumble across all types of nexus while they're looking for it. And it may be a bad situation if you've got 5 years of economic nexus and have not done anything about it. But what happens if you've got, third party nexus for 12 years? That's a heck of a lot worse than economic nexus for 5 years. I mean, nexus is nexus, but it's the length of time that's the killer. So that's why I believe that nexus matters more than ever. We've got a lot of people concentrating on economic nexus. I think that's just part of the story. And at this point, Ellie, we have any questions?
We do have a couple questions. I'm going to jump right in here for the sake of time. First question, should you register if you hit the threshold 1 year, but don't anticipate any more activity in that state and all of the sales are tax exempt per the state laws? Does it make sense to do this and then to deregister?
It depends on the state. In most states, if you don't have any taxable sales, you got to remember penalties and interest are generally based upon the tax that's owed. So if you don't have any taxable sales, even if the state says that you should get registered, this is where, that common sense needs to come in. Our clients are generally going to say, well, what happens if I don't get registered? What's the state going to do to me? And they don't get registered. Now, other states are saying, like state of Texas, if you don't file a return, it's a $50 penalty. So not all states is it going to just look at the amount of tax owed in order to calculate that penalty. But most of our clients, except for the ones that are in a highly regulated industry, if they're in a pharmaceutical industry and they have to get other types of licenses and approvals from the state, they want to make sure that they're dotting every I and crossing every T. So they may go ahead and get registered even though they have very little exposure if they're crossing the threshold. So it all depends on your specific facts and circumstances, but most of the time, our clients are going to forego getting registered if they have no taxable sales, and they're only going to have Nexus for a short period of time.
Thank you so much, Mike. Okay, next question. So the question is, I sell only on Amazon. I had registered in 12 states when Amazon started collecting sales tax. 2 states have told me to deregister. I am still unclear on the inventory in the states. Amazon moves inventory so much, leaving vulnerable in all states. Do I need to be registered in the states due to inventory nexus?
All right. So if you're only selling on Amazon, just about all states out there have said that Amazon is responsible for the sales tax on those sales. So our clients have deregistered almost everywhere if they're only selling on Amazon. Now, if they're selling on Shopify or some other platform, that's a different story. Now we got to look at the materiality of those sales outside of Amazon, because the inventory at Amazon could be creating nexus for these other business channels. And the economic nexus includes Amazon sales in a number of states. So again, it's going to depend on your specific facts and circumstances. But I think I heard, Ellie, you say that they were only selling on Amazon. And if that's the case, even in the states that say you should stay registered, most of our clients are going to deregister. A couple of your home state, you're generally always going to want to be registered in your home state. State like Washington, if your sales are large enough, Amazon is not paying your business and occupation tax. So you're going to need to file the business and occupation tax on your own. You'll need to be registered in order to do it. And then a state like California, if you're doing drop shipping and doing it outside of Amazon, well, you have to be registered in California in order to issue a valid resale certificate. Now, if you're only doing the drop shipping through Amazon, they have addressed that and it's not an issue. But if you're selling through Shopify and maybe you only have $20,000 of sales through Shopify, but a lot of it is being drop shipped to California, you might still want to be registered in a state like that. But going back to my original premise, most of our clients are going to deregister in most of the states if they're only selling on Amazon.
All right, thank you so much, Mike, and thank you everyone else for joining. Mike, if you want to close us out here, we can end.
Well, thank you everyone for joining us today. I hope that this has been beneficial. I had a little bit of a brain freeze in the beginning, but I think I caught back up. And we hope to see you on future webinars here. Take care. Have a great day.